What if I told you that in exactly 10 years from today, you could be collecting hundreds of dollars every single month without ever clocking into work again? Not from a side hustle, not from a business, just from a decision you make right now, repeated consistently month after month. Today, we are running the full numbers on what happens when you invest just $500 a month into one of the most popular dividend ETFs on the market, SCHD. And I promise you, by the end of this video, you are going to be very excited about this. Stick around because we are going deep on this. We are talking real numbers, real projections, what your dividends actually look like year by year, how reinvesting changes everything, and what 10 years of patience actually does for you. Let's get started. What exactly is SCHD? SCHD stands for the Schwab US Dividend Equity ETF. It was launched back in 2011, and in the years since, it has become something of a cult favorite among dividend investors, and for very good reason. Here is what makes SCHD different from just picking random dividend stocks. SCHD tracks the Dow Jones US Dividend 100 Index, which sounds fancy, but really just means it filters the market for companies that have paid dividends consistently for at least 10 consecutive years, have strong cash flow, low debt, and solid return on equity. In other words, it doesn't just chase yield, it finds companies that actually earn the money they pay out. The expense ratio is just 0.06%. That is almost nothing. You are essentially getting institutional quality stock selection for free. And what about the dividend yield? Historically, it has sat in the range of 3.5 to 4% annually. That might not sound explosive, but combined with dividend growth and price appreciation, SCHD has been a return machine for patient investors. Now, let's take a look at the numbers. The setup: $500 per month, every month for 10 years. Before we run the math, let us get one thing straight. We are going to look at two scenarios: a conservative scenario using an 8% average annual total return, and a historical scenario using around 11%, which is closer to what SCHD has actually delivered since its inception when you factor in reinvested dividends. In both scenarios, we are assuming you reinvest every single dividend back into more shares. This is called a DRIP, or Dividend Reinvestment Plan, and it is one of the most powerful forces in long-term investing. More on that in a minute. Also, we are investing $500 at the beginning of each month over 10 years. That means you personally contribute $60,000 of your own money. That's the baseline. Now, let's watch what happens to it. The conservative scenario: 8% annual return. At 8% average annual growth, your portfolio after 10 years would be sitting at approximately $91,500. You put in $60,000, the market added roughly $31,500 in growth and compounded reinvested dividends. That is more than a 50% gain on top of your own contributions without you doing anything extra after the initial decision. Now, here's the part that really matters. At a 3.5% dividend yield on that $91,500 portfolio, you would be generating around $3,200 per year in dividends. That is about $267 every single month in completely passive income. Is $267 a month life-changing on its own? No, it's not. But remember, you have only been at this for 10 years, and $267 a month is real money. And here is the thing about SCHD specifically. It is not just paying you a dividend. It has historically grown that dividend every year. The average dividend growth rate for SCHD has been around 11 to 12% annually. So that $267 per month does not stay at $267. It keeps climbing year after year, even if you stop investing entirely. The historical scenario: 11% annual return. Now, let us look at what happens if SCHD performs closer to its historical average of around 11% per year in total return. At 11% after 10 years of putting in $500 a month, your portfolio would be worth approximately $108,500. You contributed $60,000. The combination of price appreciation and reinvested dividends added about $48,500 on top. You almost doubled your money. At a 3.5% yield on $108,500, you are now collecting roughly $3,800 per year in dividends. That is about $316 per month in passive income. And once again, because SCHD tends to grow its dividend at a double-digit rate each year, by the time you hit year 12 or 13 or 14, that $316 per month is very likely $350, then $400, then pushing $500 a month in pure dividend income without you adding another cent. 520 weapon: dividend reinvestment. I want to pause here and make sure you really understand why reinvesting your dividends is so critical in the early years, because this is where most people underestimate the math. When you reinvest a dividend, you are buying more shares. More shares means more dividends next quarter. More dividends next quarter means more shares, and on and on and on. This is compounding in its purest form. Now, some claim Albert Einstein called compound interest the eighth wonder of the world, and whether he actually said that or not, the math does not lie. In the first year of your SCHD journey, your reinvested dividends might only buy you a handful of extra shares. It feels almost meaningless, but by year 7, 8, or 9, those reinvested dividends are buying dozens of additional shares every single quarter. Your portfolio starts feeding itself, and that is when the snowball really starts rolling. If you turned off dividend reinvestment and just pocketed every dividend payment instead, your 10-year result would be noticeably smaller. The compounding effect of reinvesting is estimated to account for roughly 30 to 40% of your total long-term return in a fund like SCHD. That is massive. If you are finding this valuable, go ahead and hit that like button and subscribe to the channel. Year by year, how your portfolio actually grows. Let us walk through what this actually looks like in real time, because I find that understanding the journey matters just as much as knowing the destination. In year 1, you invest $6,000. Your portfolio might be worth around $6,300 to $6,400 by year end, depending on market conditions. Your dividends generated this year are modest, maybe $200 to $230 for the whole year. You reinvest them. It doesn't feel exciting yet. That's normal. By year 3, you've put in $18,000.
Your portfolio might be sitting around $20,000 to $21,000. Your annual dividends are now approaching $700 to $750. Still not life-changing, but the curve is starting to bend upward. Year 5 is where things start to feel real. You have contributed $30,000. Your portfolio in the historical scenario is likely worth around $38,000 to $40,000. Your annual dividend income is now somewhere around $1,300 to $1,400. That is more than $100 a month in passive income, and it is accelerating. By year 7, total contributions hit $42,000, but your portfolio is approaching $60,000. The gap between what you put in and what you have is widening fast. Annual dividends are now in the $2,000 range. That is $166 a month. Year 10, $60,000 contributed. The portfolio value is north of $100,000 in either the conservative and historical scenarios. Dividends approaching or exceeding $300 per month, and a compounding machine that, if left alone, will continue growing whether you add more money or not. What happens if you keep going beyond 10 years? I cannot let you leave without showing you what happens if you just keep going. If you continue that same $500 a month into SCHD at 11% for 20 years, your portfolio grows to somewhere around $430,000. You personally contributed $120,000.
907, the market added over $310,000 on top of that. And your annual dividend income at that point would be in the neighborhood of $15,000 per year. That is $1,250 every single month in passive dividends from just $500 a month invested consistently. At 30 years, the numbers become almost hard to believe, but that is the math of compounding. It rewards patience more than it rewards brilliance. The risks you need to know. Now, I would be doing you a disservice if I did not spend a minute on the risks, because no investment is guaranteed, and SCHD is not immune to downturns. During a market crash, SCHD will go down. In 2022, SCHD dropped roughly 9% for the year, while the broader market fell much harder. So it has historically held up better than most during rough patches, but you will still see red in your portfolio from time to time. The question is whether you have the discipline to stay invested and keep making those monthly contributions when everything looks scary. The biggest risk with a strategy like this is not market volatility, it is behavioral. It is the investor who sees their portfolio drop 15% and panic sells, locking in losses and missing the recovery. The math only works if you stay in the game. Also worth noting, past performance does not guarantee future results. SCHD has been exceptional over the last decade plus, but no fund or strategy delivers the exact same returns forever. Diversification matters, and SCHD works best as a core holding alongside other asset classes rather than your only investment. Is $500 per month realistic? I hear this question a lot, and I want to address it honestly. For some people, $500 a month is a stretch. For others, it is easy. And for some people watching this, they have $500 a month available. They just have not directed it toward this kind of wealth building yet. If $500 is too much right now, start with $250 or whatever you can do. The exact amount matters less than the habit. The investor who puts in $250 a month for 20 years almost always ends up wealthier than the investor who waits until they can afford $500 a month and never gets started. The best time to plant a tree was 20 years ago. The second best time is today. Final thoughts. Here is what the 10-year SCHD simulation tells us. Invest $500 a month, reinvest every dividend, keep your expense ratio low, and be patient. Do those 4 things, and in 10 years you will have turned $60,000 of your own money into somewhere between $91,000 and $108,000, depending on market conditions. You will be collecting somewhere between $267 and $316 per month in passive dividend income, and you will have a compounding machine that, if you keep feeding it or even just leave it alone, will continue to grow for decades. That is not a get-rich-quick scheme. It's simple math. And the most beautiful part, you do not need to be a financial genius to do this. You do not need to pick individual stocks, time the market, or spend hours analyzing earnings reports. You just need an account, $500 a month, and the patience to let time do the heavy lifting. SCHD has given dividend investors a repeatable, low-cost, high-quality vehicle to build wealth. Whether it continues to perform at historical rates or comes in more conservative, the principle holds. Consistent investing in quality dividend stocks with dividends reinvested builds generational wealth over time. If this video helped you see the power of long-term dividend investing, I would really appreciate it if you dropped a like and hit subscribe. It helps this channel grow and lets me keep creating content that actually shows you the math behind building real financial freedom. Until then, keep investing, stay patient, and remember, the best portfolio is the one you can stick with. I'll see you in the next one.